Could you describe your investment methodology? In what kind of companies you invest?
Well, when we're looking to invest, we're principally looking for high quality businesses. So our focus when we're looking for an investment is the strength of the business model. What we're looking for is companies that generate high returns, so high return on capital, and we want that business to be able to continue to generate that high return for a long period of time. So what we want is companies that have high barriers to entry, they have pricing power over their suppliers, and they have pricing power over their customers, which means that they can continue to generate high returns and therefore be creating shareholder value for investors.
How correlated is your portfolio to the current European macroeconomic backdrop?
So, I mean, in general for the portfolio, we are more exposed to global growth so we're investing in exporters, so global growth, exporting companies. But clearly we do, the companies we're investing in do have some exposure to the domestic markets. But even when you've got austerity, there are companies that can benefit from the difficult times that we're seeing at the moment. So we're invested in some companies that will benefit from the down trading trend, which we expect to occur as a result of austerity measures. We are investing in companies that will gain market share in tough times when some of their competitors fall away from the market. So we're looking for, again, the strong companies which we expect to get stronger in difficult economic times.
Would you give us an example of a company in your portfolio that does well during difficult economic times?
Sure. So we're investing in a Swedish auto repair company. So what you're seeing is if you have a high-end car, historically you would have got that car serviced, repaired in the dealership. So you'd have taken your Mercedes to a Mercedes dealership. It would have cost you a lot of money. And now in tougher times, you would look to go for a cheaper alternative. Now that might mean you go to a man down the road who can mend your car, but if you've got an expensive car, you want to have a trusted supplier, a trusted auto repair shop. And Mekonomen is a quality brand that is able to repair any sort of car, not just the Mercedes, not just the BMW. So they can repair any sort of car. As a result of that, they get much higher throughput through their garages than the dealership. That higher throughput means that they have better purchasing power over their suppliers and they can pass on those benefits to their own customers, and therefore they're charging lower prices for the same service that you would have got at your dealership. And so this is a company that benefits from the general downtrading trend that we're seeing. Another example could be in Germany. We're invested in a leasing company called Grenke Leasing. Now they are benefiting because a lot of the large banks are moving out of the leasing market. So leasing small business and small IT equipment to small and medium-sized enterprises. They are taking market share as the larger players leave the market, and they're also building up an information advantage by gaining that share and understanding their customer base better than the larger players in the market. So these are two examples where the downtrading trend and the strong getting stronger is clearly coming through.
What kind of earning prospects the small and medium cap universe face for 2013?
If you look at the universe in aggregate, currently estimates are for high teen 20% earnings growth for this year and high teens earnings growth next year as well. So it would suggest that there's a lot of growth potential in the market, and that's from under-earning businesses that have been underperforming, performing better. I think those estimates are probably too high, particularly given the uncertainty and the volatility in the economic environment that we're seeing today. So I would judge that there will be downgrades to earnings expectations as we go forward from what we see today, and that will act as a bit of a headwind for equity markets in general.
Do you see a pickup in M&A activities in the small and medium cap universe in 2013?
I mean, clearly money is relatively cheap at the moment, particularly for good, high quality businesses. Strong businesses are able to raise very cheap debt, and they can either deploy that money by investing in their own shares or through M&A. And we are clearly seeing evidence of that. I mean, certainly in the large cap in the US, You've had Dell being taken private. You've had the Heinz business being acquired. You've had ABI buying Modelo in South America, Latin America. And in small cap, we're seeing it too. So we are seeing a pickup. I mean, I still think, last year we didn't see as much M&A activity as we expected. It was the dog that didn't bark, if you like. But this year we would expect increased activity. We've seen a company in the Nordic region, a company called Höganäs, which is being acquired. That was announced last week. In the telecom sector, there's been Virgin Media in the UK that's being acquired. Telenet has been bid for in Belgium. And in Germany, there's rumors also of Kabel Deutschland becoming prey to Vodafone. So there's definite activity in the M&A arena, and I would say that our impression is that activity is picking up at the moment, and that should be very positive for small and mid-cap in particular, because obviously there's greater opportunity of that size of business being acquired by larger acquirers.